Welcome back, everyone, for another deep dive. So, there are countless players in the fintech space, but few with a story like this one. Shift4 is a billion-dollar payments platform that's been quietly operating for over 25 years, and it was started by a 16-year-old kid in his father's basement. And at first glance, you might think that a company this old has already seen its best years. But the truth is, Shift4 is shifting gears. And in today's video, we're going to go past the surface level headlines, unpack the business model, look at the opportunities ahead, and look at the risks involved in this company. And there's going to be something in there for beginner investor to the more seasoned investors. And even if this stock isn't for you, I'm sure there's going to be lessons in there that are going to be worth your time. So let's get right into it. So let's bring everyone up to speed about Shift4 and what they do. Shift4, simply put, is an integrated payments platform, specifically a vertically integrated payments platform. And they offer two main things: point of sale solutions, that's the hardware, and the software associated with that, as well as a layer of payment processing to go along with this. So let's take the example of a restaurant. A restaurant might have online ordering, and it might have in-house reservation, as well as QR payments, and then payments processing at the very end. So these costs add up quite quickly. And what Shift4 does is it says, well, you know what? You can get rid of all those different types of vendors. We'll handle everything from start to finish. So let's take a look at some of the flagship products they're offering at Shift4. So their number one product is the SkyTab point of sale solution. Now, at first glance, you might think this is not very impressive, but later on, you'll see how complicated these things can get. But I'll just start by discussing some of these options that you can do, as we already mentioned: order entry, table management, modifying, splitting checks, payment acceptance, say like QRs and buy now, pay later, or let's say mobile wallets. I know this sounds very basic, but the fact that it's all integrated into one solution is their key differentiator right now. And then you, of course, have the complementary third-party software integrations such as DoorDash, or you might have to book a table, for example. You could all do this through the one integrated software solution that they have. And then they have their tertiary products or secondary products, I would say. So you can build turnkey solution websites if you want for your actual, let's say, e-commerce business. And then you have their Lighthouse Business Manager solution, which centralizes all analytics and real-time data analysis into one software tool. Now, this is extremely helpful for businesses who have multiple locations, who want to track their sales, their inventory, their performances, even their labor scheduling. You can handle this all within this one software tool. And these are really useful value-added services they can layer on top of their primary SkyTab offering as well, which increases their revenue generated per customer. And here you can see the many different types of integrations you have with the SkyTab offering. This isn't something very unique to them, but I thought I'd just cover it as well, such as MailChimp. You've got the OpenTable, Uber Eats, all the things that you might need as a business, you can integrate within the Shift4 ecosystem easily. Oh, and I forgot to add, they keep increasing the value-added services. So they've recently added the gift cards and loyalty program. So basically, you don't need to go elsewhere. You can find that all within the SkyTab offering. And just to put a bow on it and make sure the point has hit home, I wanted to show you a diagram or some illustration that will help get the point through with not so many words. And this is the best I could come up with, so please do take this with a pinch of salt. This is not from the actual official Shift4 website. Let's start by describing the three pillars of, let's say, the SkyTab POS system, which are the hardware products, the software services, and the support services. Now, the hardware products I've already maybe mentioned, or you've seen in the slide previously. You've got the display system, let's say the kitchen display systems. Once an order goes through, the kitchen staff need to see it. And then you have the POS terminals, which we talked about, let's say like the SkyTab kiosk, SkyTab Air, which is their more wireless solutions, or the smaller iPad versions. And then you have accessories such as printers, cash drawers, cash readers. Software services, we've already talked a bit about those services that they offer, so I'm not going to go over that too much. So those were like, let's say, the loyalty marketing, analytics, etc. And then, of course, the most important thing to have that brings this whole thing together is support services. You need to be able to offer good hardware support, good software support as well. And this is what encompasses the entire SkyTab POS system. But here's the thing, this isn't even their entire business. Remember, we talked about this as being one pillar, and there's another pillar, which is the payment processing, and we're going to talk about that soon. So basically, this chart illustrates the point I was just making, which is to say that not all their revenue is tied to SkyTab. Most of their revenue is actually coming from payments. You might have thought that they were generating most of their revenue from the POS solutions. However, 75% of their revenue is coming from payments alone, and only 25% is coming from their SkyTab POS solutions and value-added services attached to those. And this image right here illustrates what I thought of Shift4 when I first started studying them, and that they've got their payment processing and their point of sale solutions, which leads to their vertically integrated payments platform. However, I've got it all wrong. And let me tell you why. The truth is, instead of thinking of POS and payment processing as these dual engines, it makes more sense to think of it like this. They currently operate in 4 verticals: restaurants, hospitality, sports and entertainment, and unified commerce, which is like retail. Let's say they were to add a new vertical, one down to the side of the unified commerce. What would happen then is that the payments platform would horizontally expand to cover the new vertical. And that is key for this business. And there are a lot of benefits to designing a system like this. Now, payments is an area that I was avoiding like the plague, but unfortunately I'm back here. I don't know how. So just to preface, I don't want to be covering too much the details and intricacies of the payments layer, because there's a lot of overlap and there's a lot of things that we could just be getting bogged down on for a very long time in this video. But we just want to understand where Shift4 fits into this ecosystem in terms of how much of it does it control, or how much of it can it actually take advantage of. And it started off initially as a payment processor as well as a gateway. So they would handle and transmit payment details from the merchant to the customer, as well as sending details to, let's say, MasterCard and Visa, and getting authorization, checking for fraud, encrypting the data, all that within their capabilities. And lately they've expanded into becoming a merchant acquirer, only in certain geographies outside of the US. The main benefit of being a merchant acquirer is that you'll be able to keep a portion of the fees associated with merchant acquirers, but the downside is that you bear a lot more of the risk associated with any fraud. Just to give you an example, Adyen, which is a competitor to Shift4, is a merchant acquirer and is also a merchant acquiring bank in the US. And they are able to bypass a certain portion of the fees because of that position they're in. And here you're able to see a snapshot of the different companies within the payment rails ecosystem. And you can see here that Shift4 is being mentioned as a gateway and facilitator. And there's an additional category of what's called ISOs, MSPs, ISVs, and VARs as well. Simply put, these ISOs and VARs are partner distributors who can sell Shift4's products as a white label solution, or even as a separate solution directly to other merchants. And here's a perfect example. I will link to these images. I promise to give credit where it's due. They are showing how a $100 transaction is being divided up. So let's say a merchant is supposed to pocket $100. Well, it's not all his. He ends up with around $97.88. And a large portion goes to credit card issuers. That's the issuing bank of the consumer. So that's $1.54 gone there. And then you have the credit card, MasterCard, Visas taking 10 cents. And then the 12 cents that goes to the acquirers. Remember when we mentioned the Adyen situation, and also potentially for Shift4 in Europe, they can also pocket that for themselves. But the main thing that goes to Shift4 is usually 36 cents. So the main thing I want you to take away from this slide is the fact that if you own more of the network, you get to keep more of the fees. So we can't really discuss payment processing for Shift4 without discussing card present versus card not present. So card present is quite intuitive to think about. You have to have your card. But what's card not present? Let's define that specifically. Card not present means transactions or payments where the cardholder authorizes payment by entering the card details manually. And certain companies have been very successful in the card not present space, specifically Stripe, which is not a public company. And obviously, card not present lends itself more for these e-commerce transactions in comparison to card present, which is more for retail transactions, etc. The difficulty and complexity associated with these card present transactions is that you've got the physical hardware, you've got the encryption and security, regional fragmentation, basically different processes for each different country, and operational complexity. When you have a huge area to offer your services in, let's say a stadium, for example, things can get slightly out of hand. In comparison to just a plug and play API that Stripe or Adyen can run, it's a lot more complicated. But back to Shift4 and what they're very good at. They're very good at card present, and they're operating in these 4 verticals. I've just clipped the text, I'm sorry. That's restaurants, hospitality, sports and restaurants, and unified e-commerce. That's the newest vertical they're trying to penetrate. Now, they claim they're number 2 in restaurants. They are clearly behind Toast on that one. And they are number 1 in hospitality, and that's resorts and lodging. And they're also number 1 in sports and entertainment. They are number 1 by far in that. They're also expanding into potentially public transportation, things like taxis, car rentals, anything that requires physical presence. So let's examine how good this company is at executing and entering a new vertical. Now, sports and entertainment is a new vertical altogether. It did not exist before 3 or 4 years. They entered this around 2021, and since then they've captured almost 70% market share in all stadiums across the US, in all different sports. And you can see how they've been able to execute so well, because what started off as an initial partnership with Venue Next, a very small acquisition they've done, they've managed to scale this complementary system alongside their SkyType offering and payment processing and roll it out nationwide. And it doesn't have to stop in the US. They can expand this even further. Of course, there's only so many stadiums out there, but this is a crucial thing to understand, because if they've managed to execute it so perfectly into an underpenetrated, market, which is what they've seen in the actual stadiums and events, is that there was actually not a lot of players in this space. Well, they can do this again in another vertical and then another vertical after this. So it's just a very nice illustration of what they can potentially execute down the line as well. And just to let things ferment, I'm going to share a few of these images in terms of where they've been rolling out their services. You can see here they're in casinos in Vegas as well. They have a very strong foothold there. And they're also in the hotel business and other areas with lodging and resorts. And they've also, you can see it makes sense to have them in zoos, aquariums across the US. And Glastonbury makes, if you haven't heard of Glastonbury, this is a very huge festival in the in the UK. And that's basically their own Woodstock, not quite as big as Woodstock, but it's a big thing in the UK. I lived there for a long time, so I can tell you this is huge. You can see by the number of crowds. They can roll this out to Glastonbury, they can roll this out anywhere else as well. And ticketing is the lifeblood of this business. You can see here this ticketing win. That means basically anything that's bought on Ticketmaster, any third-party integration, anybody that goes in through the stadium, they take a cut of that, which is huge because you get like 60,000 people coming in one go, which is great. And you can pocket all that money. And that's what they're looking to do. Another small thing is the profits, which I don't think is a huge pie. Just thought I'd mention it because they do work with these as well. And some more recent win, Aspen Hospitality. Never been there myself. I hope somebody enjoyed that. And then you've got the PGA Tour. That's a big win as well. And okay, here is actually the signature win for SkyTab, or the SkyTab venue, which is their separate platform for managing stadiums and entertainment. So SkyTab POS is for the restaurants and other hospitality side of things. This is specifically for the sports and entertainment that they have. Now, Allegiant Stadium was their first big signing that they made, and that opened all doors for them. Now, I've been there actually this summer, and I was blown away how big and how awesome the stadium was. And I thought, oh yeah, all stadiums in America are like this. But seriously, this thing is out of this world. And there's an interview with the CEO of Allegiant Stadium, or let's say the Raiders, I believe that. He says,
so with Shift4's help, we were able to decrease our wait time by 10 seconds year over year. Since the opening, we've had over 4.2 million transactions that have taken place in the stadium. We were voted by the NFL Fan Survey the #1 stadium in the world.
So I hope you got the picture of how good this stadium is. And basically, this is what Shift4 is trying to say, is that you've got multiple different vendors handling multiple different things. We then consolidate everything into one platform for you that's handled by Shift4. 4 is just their logo, right? Don't get confused with that. So they're handling everything from concessions, parking, loyalty, gift cards, ticketing, all at the same time. And it's high volume business. You've got a lot of people coming in through the doors at one time. They need to execute without a fault. And just to share something else again with you, this is how I would, describe the SkyTab venue ecosystem compared to the SkyTab POS system, whereby you've got your different revenue streams, concessions, retail, ticketing, and parking, and then you have the experiential stuff, as well as the POS system that they still need to run as well, and then you have support services. So it's very similar, but just designed for a different vertical. And you'll see that this is a very strong theme that they have, is that they go in there and they design specific products for different customers. And that is their key differentiator. They're like, well, we love to solve problems. Just give me a problem, I'll throw you a solution. So now that we've understood Shift4's POS solutions and also their positioning in the payment processing, we can start to take a look at this diagram sourced from flagship partners. And you can see that Adyen and Stripe, which we've mentioned, are positions toward the payment side of the ecosystem, which makes sense. And towards the software e-commerce side, you have Shopify here in this area. And Shift4, as we can see here, is positioned toward the POS side of things. Now, recently, they've also had acquisitions of Revel and Spot On, and they've had these as part of their roll-up in terms of the SkyTab POS. However, they also had a very recent acquisition of Global Blue, which pushes them more towards the e-commerce side of things. So you could almost say they're playing right bang in the middle here between everything else, which I'm not sure if that's the best position to be in, whether specialized or generalized, but they are definitely expanding in terms of their acquisitions, and we're going to see why or how they've been doing this. So as of their IPO in 2020 during COVID, they were operating only in America. So that was the only geography they operated in. But now you can see that they've expanded massively. And now 32% of the revenue is coming from international, which is a huge jump over 5 years. And the way they've done that is no secret at this point. Well, they've done a lot of acquisitions. There's some acquisitions coming soon that are going to open doors in Australia. They've had acquisitions across Europe as well. And these are opening doors for them. And whether this is a strategy they can keep implementing moving forward, we're going to have to take a closer look at. But for now, let's focus on some of their key metrics. They have over 200,000 merchants right now who are signed up with them. And these are starting to lean a lot more towards the SMB, small, medium businesses, and enterprise. And the largest customer they have only accounts for 3%, which is a good stat to have. They don't have a lot of customer concentration, which means they can pay more on a customer acquisition because these customers will stay with them for longer. Historically, if they signed up a restaurant, these would be mom and pop shops that potentially went out of business in less than 3 years, and therefore they lost a customer, not due to the bad service that they're offering, but mainly due to the fact that this is a very hard business that they're operating in, and as such, these customers went under. So how are they reaching these customers? That's a key question to answer. Well, if you recall, we mentioned the ISVs and the value-added resellers. This is where they come in. Now, at IPO, when they IPO'd, let's say 2020, 5 years ago, 100% of their customers that were coming through the door for their restaurants and hospitality, which were the two verticals they were operating in, were coming through these partner solutions. And now that has shifted significantly. They are now getting a third of their customers for restaurants through their own sales and marketing team. And as well, for hospitality, they're getting half of them through the door directly. For these new verticals they have, they're also getting 100%. So now we're getting into the number side of things. Now, briefly, I mentioned the gross revenue less network fees. That's the revenue figure that Shift4 likes to quote. However, I'm not sure if that's the one I would like to use myself. Because of course, network fees are something that most companies cannot negate. Adyen, Stripe, everybody has to pay network fees. However, not all network fees are equal. Some companies, if you were to compare apples to apples, let's say Stripe and Adyen and let's say Shift4, they might have different network fees. And as such, you might not be able to see any of the advantages that one company has over the other if we just look at the net revenue. And as such, sometimes I prefer to look at the gross revenue to make a better comparison about why there's a difference in gross margin between those numbers and the numbers that you might find with another company. And you can see how fast the gross revenues been growing. And over 7 years or so, that's 33% growth. That's wild. And they highlight that themselves in this slide. You can see their end-to-end payment volume, which has gone from 47 billion to 160 billion. That's a 52% growth rate. And then you have their gross revenue less network fees, which is growing at 37%. And some of you out there who are paying a bit more attention might be saying, all right, so what's going on here? Why is the gross revenue growing less than the payment volumes? Well, we're going to get into why that is in a second. So just one last thing to add about the net revenue here, which is sitting at 1.35 billion. What reduces net revenue down to the gross profit would be their customer acquisition cost, as we mentioned previously, as well as the acquisition buyouts. Now, we did mention a little bit about that previously, about how the ISVs and value-added resellers do take a fee for any of the merchants they bring over to Shift4. And we're going to see how in the financials that actually shows up in a little bit. So now let's start to look at the balance sheet side of things, because that's one of the most important parts for a company such as Shift4, because it is a very acquisitive company. This company is starting around 2024 in the first quarter, had around 72% of debt relative to equity, 28%, and that has been shifting now to 78% in debt. So the company is taking on more debt over time. Well, why that's a good thing as an equity holder, we're not getting diluted. More debt is not usually what you'd like to see as well. The company has been actually reinvesting heavily into itself. Some of that is for internally developed software. However, that's not what's driving up this debt itself. Most of the debt is coming from these acquisitions they've recently done, and we're going to cover that shortly. So what are the key performance indicators to watch for this company? Now, the company highlights some of these themselves. End-to-end payment volume. Now, this is one of those that is just crucial for this type of business, because at the end of the day, creating a new vertical, you need to layer on top of it a payment processing type of business or type of service, because otherwise it's not very accretive for them to open up into a new vertical. If you cannot do that just purely for the POS side of things, it is not worth it. So remember, payments is the bread and butter for this business. EBITDA and adjusted EBITDA is another figure that they use because that's tied into their compensation as well. And then you have their payment revenue, subscription revenue that they break out. Now, lastly, I do mention here network take rate, but I'm sorry that it's supposed to be take rate itself, which is a small difference because network take rate is the take rate associated with, let's say, a Visa or MasterCard that they have no control over, but they do have control over their own take rate that they charge merchants. For example, if it's a large enterprise customer, they can say, well, we're going to reduce our fees and therefore have a lower take rate associated with that. And I'll show you a graph that really highlights this clearly in a next or a couple of slides. So looking again at the research and development investment, they don't really invest that much onto their R&D. I'm not going to spend a lot of time on this slide. They spend around 2% of their gross revenue on R&D, which is a very small portion of investment that they do. A lot of their reinvestment is coming through their acquisitions. Now, this is more advanced than the normal slides I would usually put, but I kept it in here for those investors who want to know a little bit more. These are associated with, let's say, the ISVs and the value-added resellers that come in and bring in their merchants with them to Shift4. And let's say Shift4 says, well, instead of paying you a rolling commission, we're just going to pay you a one-time fee. And that one-time fee then gets rid of any obligations that they have to that ISV or value-added reseller. And that basically would normally show up as an expense, but they treat it as an asset and therefore it doesn't show up on the income statement. And therefore, they get pretty good margins. However, it is amortized, and because it's amortized, you can see the asset amortization, they get improved margins from that. So it's a real cost. However, it's shown up over time on the actual, financial statements. And as such, you can get depressed GAAP earnings or operating profit, but your margins or gross margin at least improves overall. Now, this is a real cost, and it's something that is an intangible asset. And we're going to touch on intangible assets a bit more down the line. The difference between the residual commission buyouts and the capitalized customer acquisitions, the latter one is the ones associated with the sales and marketing team because they do pay a bonus for their sales and marketing team whenever they do bring in a customer directly to their door. And again, this is part of that whole discussion about the intangible assets. You can see that over the course of the next coming years, how much intangible assets are accounting for. And you can see that there's 970 million in intangible assets for this business. That is massive. Considering that the net revenue for this business is 1.35 billion, there's 970 million of intangible assets. And of those, there's 791, that is what they could consider amortization of acquired intangibles. That means most of that is acquired, rather than generated internally from their software and other things that they would consider their own proprietary, let's say, trademarks or patents if they have any. So the take-home message here is there's a lot of intangible assets to be wary of in this business. And we're going to talk about how we can deal with this because although intangible assets are a real cost, there's different nuances on how we could treat this. All right, so it was really hard to get on one slide all of their acquisitions, so I'm really sorry if I missed out some of them, but these are a lot of their key acquisitions when they really started to ramp up around 2018. You can see here they started with their POS consolidation or / roll-up, and these mainly focused on their restaurant side of things. Then you had the merchant link integration. And anything that shows up in green basically is anything that's targeted mainly towards their SkyTab offering. And you can see that later on in 2021, they're like, all right, well, let's start looking into different verticals. And they had their initial Venue Next acquisition, which we talked about. That opened the door for their sports and entertainment. And then they expanded into other things, which are a little bit more on the, let's say, periphery, the giving block. So this is like basically about like donations and things like that. And then you had their, again, Spot On and Appetize. These were a Finara acquisition. Finara was the one that gave them access to the payment processing side of things for being an acquirer in Europe. That was a very good extension of their capabilities. And then they had their international expansion. So you had the GiveX and Vectron and iGen and Global, Blue, and SmartPay. These are the most recent acquisitions, which we're going to spend a lot of time talking about those ones. And another way to see this is to take a look at their milestones of acquisitions. You can see that from their founding in 1999. There's nothing really happening here. There's nothing on this slide. On the y-axis is supposed to show you the value of the acquisition. There's nothing to see here. They had maybe one acquisition up until 2015, 2016, and that was it. So there was one acquisition up until 2016, but things started to ramp up quickly. So now we're starting to see how their acquisition strategy is panning out. In 2017, they actually bought Shift4 and renamed themselves from, well, initially UBC to Harbor Touch to then Shift4, and that's the name they've stuck with. And since then, they've been on a tear with these acquisitions. The fact is, they were very, I think, mindful of how they were going ahead with this. And they were picking small targets, rolling them up, and then including them into their offering. And you could have thought of them initially up until 2025 as a potentially serial acquirer. And these are usually companies that are very acquisitive within their own vertical. And they would just try to own the entire supply chain up and down. And that could have been a category I would have categorized Shift4 as, because they were showing some effectiveness in rolling out this strategy over a number of years. However, you can see here now things have blown out of the water with the most recent acquisition. They've just acquired Global Blue around, I think they finalized it in June or July 3rd of this year. And this acquisition was a whopping 2.7 billion. And yeah, compared to their acquisitions, which were in the around 300 to 400 million range, this is astronomical. And it's actually 40% of their market cap. So you can start to see where some yellow flags are starting to show up in this business. And this is a slide straight out of their own investor presentation, and it really highlights what they're thinking about whenever they're going for an acquisition, is that they're targeting either international expansion, capability enhancement, or the top of funnel and delete the parts. Well, we're going to talk about delete the parts later, but top of funnel, what they mean by that is basically getting a customer acquiring a company just purely for the amount of merchants they have. They've just recently done that with a company called Vectron, where they've gotten 70,000 merchants from that. And these were a base of customers that were not monetized. What I mean by that is they were using a POS solution, but they weren't actually getting any of the payment processing layer on top of that. So basically, whenever they get these acquisitions, they can say to these customers, well, hey, we can offer you a complete suite tool where basically you can use your POS on top of the payment solutions just with us. You can get rid of those other vendors that you had previously. And they're like, oh, all right, okay, we can do that, fine. So we'll sign those customers up slowly over time. And most of those customers eventually convert to using Shift4's payment processing as opposed to their other vendors that they would use for their payment processing. And that's the beautiful flywheel that they have in place whenever they talk about top of funnel. And this is the roll up once they do the delete the parts. Basically, this is actually really good in terms of the synergies. You can see that they have a very, very specific strategy whenever they acquire a company, is that if there's nothing additive in terms of an acquisition, we're just going to delete it. If actually the acquisition offers a better product or service than what we currently have, we're going to delete ours. They saw that GiveX had a better gift card and loyalty program than they had with their existing offering. So they said, okay, we're going to delete ours then. No need to keep, rolling extra funds into our own software development for this. We're just going to use GiveX instead. So they're very mindful about keeping things lean. And there's no bloat in the system. They're getting rid of everything as soon as they can. So eventually, Vectron is going to be rolled into SkyTab, I believe, whereas GiveX and SkyTab Venue and the Giving Block might just be their own standalone product, along with Global Blue, which will fit in probably right in the cross-section or the trifecta of being a capability enhancement, top of funnel, and international expansion. And we're going to take a look at that hopefully shortly. So what does Global Blue actually do? I don't think I've actually mentioned that yet. Well, let's read this out here. They're the leading specialty payments platform enabling tax-free shopping, dynamic currency conversion, and payment solutions to the world's largest retail brand. Well, the key thing here to point out is the tax-free shopping. What a lot of people do sometimes when they go shopping is they'll ask for the tax refund if possible, because there's a lot of arrangements for countries to say, okay, you don't need to spend the tax in this country since you're not an actual resident in this country as a tourist, which makes sense. But I think in the US when we went, it was like, yeah, you need to still pay it. So there are some countries that they're still rolling this into, and I think a few of them that are signing up recently with Global Blue. But a lot of shoppers, especially Asian shoppers, will want to seek out this Global Blue refund if possible, and they are the clear market leader in this area with owning around 80% market share. And interestingly enough, talking about the Asian customers, Ant International and Tencent Group were minor stakeholders in Global Blue and will remain so following the Global Blue acquisition. And here are some key metrics I'll leave here for you. I've already mentioned most of these, but it's one key thing to mention is that they paid a 15% premium over the current share price when they bought this company at $7.50. All right, so let's continue on with what this Global Blue deal unlocks for Shift4. They get access to dynamic currency conversion. Now, this might seem like a very small thing, just like a SkyTab POS, but it's really important for a lot of customers. Whenever they're transacting abroad, they'd like to probably get to choose whichever currency they'd like to transact in. So this gives them the option to do that. Let's say if you're coming from China, would you like to pay in the US denominated currency or in your Chinese yen, for example? And that gives them the option to do that. And that then they could actually leverage across their entire payment ecosystem. So for example, they could start offering this now across all their verticals, not just within the Global Blue ecosystem. They could just leverage that, and the marginal cost of doing so is very small. The other side of the equation is that Global Blue now gets access to the POS system that SkyTab offers as well. They also get access to the high value customers. Now, again, we've got to keep referencing this because Asia is a big market for Global Blue, and luxury retail is huge in the Asian countries, especially in China. However, obviously, recently there's been some deglobalization, and the Chinese consumer has been a little bit more frugal than they usually are in their spending, and that has reflected a little bit. But if demand was to shoot back up, that will obviously be a big boon for Shift4 and Global Blue now. And you can see here by the sheer number of high premium brands that they have. You can take a look at some of these. Chloe, Boss, Bodega Veneta, there's Hermes as well, and a lot of these premium brands. With premium brands comes premium payment processing as well. It's a percentage-based fee probably as well. So they're getting a lot of these customers through the door, and these premium customers are probably worth 5 or X more than your average, consumer. So now let's take a look at the potential optionality within this business. This optionality refers to potential other avenues or revenue streams or verticals they could enter. And specifically in the case of Global Blue, I think we need to take a look at the minority interest associated with the Tencent holding and the Ant Group. Now, what I mean by that is they have a minority stake, actually, just to correct myself. And this minority stake is quite important because it allows them to then have access to the Chinese market, potentially down the line. And Asian markets are quite different than other markets in that, as you can see from this graphic here, that there's 70% of all transactions are now happening through the digital wallet. And these wallets are, well, it's important to know how they're being funded. Most of these are being funded now through direct bank transfers, as opposed to leveraging the use of a, let's say, Visa or MasterCard. They are bypassing those rails. And as such, they avoid those network fees. Now, what that means is that there's going to be lower network fees associated with these transactions for Shift4 and potentially higher gross margins and therefore higher net revenue. And this might be a more lucrative acquisition that might appear on at first glance. And I think it's not that far off to say that within the next 5 years, they'll be expanding into China. So yeah, this is the slide they've shared on their investor presentation, and this was sometime in February of 2025, so the numbers might have changed ever so slightly. However, you can take a look at Shift4's net revenue, which is 1.4 billion, and their adjusted EBITDA, which is 0.7 billion. Global Blue, again, sitting is on 500 million revenue with around EBITDA of 200 million. So again, the combined entity is going to be worth a whole lot more. So let's take a look at the details of this actual deal. Now, we just want to figure out whether or not they overpaid for this deal or not, or they've gotten a sweet deal we just don't know about. And this is a bit more advanced, so if you feel like this is too much, you can go ahead and skip. It's not too crazy, to be honest with you. We're not going to be doing any number crunching right now. But so they paid around 13 times EV to EBITDA. Now, that's their enterprise value divided by their operating income plus depreciation and amortization. Now, whether or not that's actually good, well, one way of looking at that is to say, well, if you converted that to yield, how much would that be? And you could take a look and say, well, they're paying around 1/13, so that yields around 7.7%. And one way to look at it is like, well, 7.7%, and how much is their cost of capital? Is that higher or lower? You could say at this value, it's not really accretive to buy this business at 13x, but they do mention that there's going to be potentially $80 million worth of synergies they could unlock, either in cross-selling or cost savings as well. Regarding any so-called synergies, if you were to ask the CEO of a Swedish cereal acquirer, Rocco, what he thought about them, he would say, well, we never pay attention to synergies. If they happen, they happen, but we don't actually plan for them. And, to be fair, I think what they were saying initially is that they weren't actually looking for any kind of delete the parts or synergies associated with this deal. As a standalone business, this is a great business and they got a good deal on it. But to sweeten the deal, yes, let's try to work out, and maybe some of you are interested, if we were to include the $80 million as part of the potential synergies, this deal turns from a 13x down to a 9x, which is actually a lot more palatable. So just for anybody who was curious as to whether or not EV to EBITDA is a useful metric to use, well, you'll be happy to know that it's actually showing a strong correlation to the PE multiple as well. So therefore, anytime there's elevated EV to EBITDA, usually there's an elevated PE. And you can see that by the linear relationship here, and it follows almost a straight line. And you're getting an R value of 0.89, which means it's almost a one-to-one relationship, basically. So it's a useful metric for us to compare to, and it's not completely as bad as some may fear. And there's not any foul play, so-called, in this metric, as you might expect. Of course, Charlie Munger might be rolling in his grave right now, but yeah, we're going to take a look at EV to EBITDA. Additionally, this is a chart from Morgan Stanley to suggest what the average multiples paid for businesses has been over the course of 25 years. And you can see the blue line suggesting the average multiple for most businesses is around 15x. So the fact that they paid 13x suggests it's slightly below the average as well, or the median. So that's a good sign that they paid below. You'd rather be below than above. So only time will tell whether or not this is a good deal. But I just wanted to share these little points in order for you to feel more comfortable with this acquisition in terms of having some reference point as well. But please make no mistake, I am not trying to sway you either way with this. I'm just trying to lay down the facts. And I just want to highlight how different this deal is, again, from all their previous acquisitions. It really does break the mold of all of what they've done in the past. In terms of the brand recognition, Global Blue is very well recognized. Additionally, it comes with a lot more geographical complexity. This business is based or headquartered in Europe, and therefore has historically been shown that businesses across wider areas or geographic areas have more difficulty synergizing and showing actual value accretion as opposed to value destruction. And to add on to that, Global Blue's acquisition, as it stands, added 2,000 more employees to the existing 4,000 employees that Shift4 had. So that's a 50% increase in their employee base, which is an astounding number to gain in a short time. So taking a look at the company's gross leverage and net leverage, you can see that they had a very, very high amount of leverage initially, but that's been going down. Now, I don't believe this is actually highlighting the post-acquisition leverage that they're going to be getting from the financing of new debt, but at the moment, it's sitting around 3.7 for gross leverage and 3.3 for net leverage. And just to highlight the difference, net leverage takes into account the cash balance that they have, and with the gross leverage not factoring this in at all. So as far as the industry analysis, we're going to take a look at some of the competitors. I've already mentioned a few, so we're not going to spend too long on that. So we've taken a look at this graphic before, but I've highlighted some of the legacy incumbents in the payment processing space, such as Chase Payment Tech, Elevon, Fiserv, which offers their Clover service, Global Payments, which is a huge player, and WorldPay. I think these are actually now combining into one company, if I'm not mistaken. And then you have the integrated payment providers, Adyen, Lightspeed, Shopify, Square, and Stripe. It's basically a bifurcation of new versus old. Now, I thought it might be useful to include this chart to highlight the payment processing business, but it's not truly reflective of what Shift4 does, because some of these, including JP Morgan and potentially Global Payments and WorldPay, as well as PayPal, they're handling different parts of the payment ecosystem. Some of them are going to be payments from person to person as opposed to merchant payments. And some of these are going to be bank transfers. So the actual volumes are not indicative of the merchant or e-commerce trade or retailer payments that are occurring for Shift4. But just to highlight, this is 3.7 trillion. So the opportunities for any transactions could be a lot higher than what they're able to achieve so far. A decent comparison for Shift4 might be to Adyen or Stripe, which are sitting roughly around 1.4 trillion payment volumes being processed right now. So there's room to grow. However, the ceiling is not the same because, as we mentioned, the card present versus card not present. And you can see clearly here the take rates differ considerably for Shift4 versus some of the competitors. Adyen is by far the clear leader, I believe, in this space. So don't quote me on this, but this is the figure I've managed to reach with some of my research. In terms of it being around 0.17. The way they're able to achieve this is because they own more of the actual vertical integration and payment space, especially by being a bank. They're able to also leverage the fact they don't use the card network for some of the transactions, not all of them, and therefore able to achieve a 0.17%, which is a very, very high target to beat or low target to beat for Shift4. But again, we said Shift4 is working in the card present space, which has its own nuances and therefore has a different set of problems that need solving, and nobody's operating in Shift4 space. As such, I'm not too worried about the take rate comparison, but I thought I'd show this here. As far as stock performance, because this is what we care about, we all want to know how it's performed so far, there's There's a few competitors I've compared Shift4 to. I've added Visa there, even though they're not direct competitors. For Shift4, they've annualized around a 12.6%, return compared to, let's say, Visa, which is around 11.3%, which is actually lower risk and pretty decent value, I would say, so far. But then all the other companies like PayPal and Toast have not returned as well. So potentially this company is doing some decent things. And here's a different set of competitors that we're going to be taking a look at. It's Toast, Shift4, Lightspeed, which is a POS competitor, as well as Shopify, because they do play in the POS space, and then Adyen. And we're going to take a look at their EBITDA margins to begin with. And we can see here, just looking at the EBITDA margins, actually, Adyen is gotten the best margins so far. But again, EBITDA as opposed to EBIT. So it's very difficult to say because, as we said, these companies have very different intangible assets. So take that with a pinch of salt. As far as the potential growth rate moving forward, the companies with the highest growth rate moving forward, actually, they're all within the 20s to 25 marks, except for Lightspeed. So I wouldn't say there's much difference there. As far as ROIC, which is the measure of return on invested capital, the company with the best record so far is going to be Adyen, and then Shopify, and then Toast, and Shift4 is sitting at around 22%. Now, the only actual value metric we're going to take a look at here is going to be the forward EV to EBITDA, which tells a different story. Shopify is sitting at around 72 EV to EBITDA, with Adyen sitting around 19, Toast sitting around 28, and then Shift4 is sitting at 6.4. So there is some disconnect there and potentially some value. Who knows? And we're going to find out shortly. So a little bit more again on the financials. Now, I'm not going to spend time looking at the revenue because we've already discussed this, at length. I think we're just going to look at their margin analysis, and specifically, I want to take a look at their adjusted EBITDA, which is the one they mention, and the EBITDA margin, which I calculate, or at least the one that they provide through the GAAP financials, if you can call it that. And there are two different figures completely. So one ends up with around 17% and the other one with around 50%. These are completely different. So it's important to know the one I calculate is very different from the one they share. Theirs includes some one-time purchases, but I'm a lot more conservative in how I calculate this. So I would probably use my figure of 17% as opposed to their figure of 50%. So this is one of the key slides I want you to take home. And I want to highlight this specifically because for anybody who knew, let's say, taking a look at this business, you might take a look at the depreciation and say, well, the depreciation is higher than the capital expenditure, therefore they're declining in growth as opposed to growing naturally. Well, yeah, organically, that might be the case because they're not spending that much internally, and capital expenditure doesn't actually measure the acquisitions as a positive capital expenditure or reinvestment, and that's not included in this. And instead, what we're getting is the actual rise in intangible assets from the acquisitions showing up in the blue bars. And that's why we have such a huge depreciation and amortization. And that's why specifically for this type of highly acquisitive company, it might be worth taking a look at EBITDA instead of the EBIT numbers. But just to highlight it on this graph, I've done the math on this, and 50 to 70% of this depreciation amortization is actually part of intangibles, which we can remove from this whole equation. Sorry, the slides don't make complete sense here. But what I meant to say was that goodwill makes up 62% of intangible assets, and 50% of intangible assets makes up the total assets, which are things like, trademarks, patents, brand, acquisition costs. All these things are tied up there. Now, depreciation and amortization. I think most people might be familiar with Warren Buffett and Charlie Munger going off on a rant, and I'm not the compendium that some many other investors are for rattling off some of their quotes. But I'm sure you know that they are not very keen on that type of metric. But it's important to note that why EBITDA makes more sense. They've shown historically how they've managed to conquer a vertical, such as the stadiums and entertainment, or sports and entertainment, and they don't need to keep acquiring within that vertical. And they can then acquire within other verticals for sure. However, I think the fact there's a finite limit of acquisitions they can carry out, they don't need to replenish these acquisitions every 5 years or so. Granted, you could argue some of the merchants may need replenishing, but I think from a prudent point of view, because it's such a big cost that a large portion of that does not need to be replenished, and eventually they built an ecosystem of cross-selling, and there's only so many companies they could potentially buy. I think you could make an argument to adding back the amortization to the operating income and getting a realistic figure for the operational efficiency of this business. Okay, and I'm sorry if I'm going to have to say intangibles once more, but the only portion of the amortization that I'm going to be adding back is the portion associated with the acquisitions, because there are some internally developed softwares that I think will keep having to be replenished. So we're only looking at the portion of the ones that are acquired, and that's 80% of that. But as a general rule of thumb, you don't have to keep reading all the 10Ks to find these footnotes. You could just add 50% of the amortization and you'll be pretty close to the right number. So now looking at the liabilities, which is what Shift4 owes, and those are some liabilities that are interest-bearing and some that are not interest-bearing. And the ones that we are concerned about are the non-interest-bearing liabilities that they're carrying on their balance sheet. As I previously mentioned, Shift4 acquired Finaro in Europe, and that allowed them to have access to acquiring services, and as such have a different model in Europe than it does in the US. And we'll take a look at that here in this diagram. What happens is Shift4 in North America, because they need a bank and a bank themselves, they need a sponsored bank, and the sponsored bank is the one that handles the settlements of the funds. They don't actually have to do that themselves in the US, and as such they have a very clean balance sheet. However, in Europe, they're able to act as a so-called bank without having a bank license and settle the funds themselves. And the funds, in the meantime, whenever they're in limbo between the merchant and the customer, sit on their balance sheet, and as such create a liability, which increases what you might think of as potentially debt for the business. So I've taken a look at this myself, and basically the total liabilities are around 4 billion and the settlement liabilities are around 300 million. So that's around 7% of the total liabilities, which we can therefore remove, and that will help us calculate a more accurate ROIC. Now, I've pulled this figure straight from the ROIC on Fiscal, and you'll see obviously they can't adjust for these small things because they're not going through the 10Ks, and I don't blame them, but they're showing a good visual of what the ROIC that you're having without doing these adjustments. Now, here is a figure that I calculate for ROIC and the return on an incremental invested capital. And they're completely different than what you'll find elsewhere, because what I tend to do is a little bit different there, what you might find, because it depends on how you calculate the actual invested capital. Some people choose, some websites you might say take a average of the last 2 years. I try to calculate it based on a lag, because I think any investment you make takes a while to show up, because any investment today is not going to show up as profit the same year or even maybe the next year. It might take actually roughly 3 years maybe. For farming industries, it could be 5 years. Based on that, you can see that the ROIC is sitting at roughly around 34%, which is a respectable figure. However, it's declining, to suggest that potentially they're reaching some kind of limit in terms of their roof for their ROIC, and they're reverting back to a mean, and potentially also their incremental invested capital is also approaching zero. Whether or not you can take these figures at face value, I think it just helps to point towards a direction that's declining from roughly 100%. They're not able to see as much leverage from their investments on their ROIC side as they did previously. So the company has taken on a lot of debt since the funding for the Global Blue acquisition. They've done that mostly through senior notes and convertible notes, and their debt is sitting right now at around 3.7 billion in total, with the current portion of debt due within the next 12 months. And that's why I don't know why it's showing up as total debt excluding the current portion, but that's the way it is illustrated here. I would say just take a look at that as a full figure of 3.7 billion outstanding. So here's a very useful slide to any new investor or even more seasoned investors who might have missed this. This is to showcase that for people who screen for stocks, you might have missed this one because you might set a value of, let's say, less than 1 for debt to equity, and that would show up as 1.52 for Shift4, and yeah, for a long time you wouldn't even spot this company. Whereas I'm calculating around 0.52. Now, the main difference for this is the fact that the equity part is being calculated for most websites using the book value of equity, which is a historical accountant-based measure of what the equity was worth at the time. And instead, what they should be using is the market value of that equity. Now, the market value of the equity reflects what the market actually thinks the stock is worth. So let's take a look at the debt structure. Now, there's a lot of debt here to take a look at. There's a convertible note that's due within the next 12 months, as we talked about already on one of the charts, and they're going to be converting that into cash, which is a good thing for us as shareholders. We don't want to see equity and dilution. So there's the two choices with a convertible note: is it could be paid off in cash, or it could be converted into shares if needs be. But yeah, we'd rather see cash payoff instead. Now, most of these are going to be cash conversions. However, what we're seeing here is that there is a Series A mandatory convertible preferred shares for $1 billion. And that's accruing a 6% dividend as well on top of that. So what does this all mean? Well, this is a different type of category. As we all know, the type of structure we have normally is that you have debt holders who are going to be repaid first before equity holders. However, preferred shareholders are sitting somewhere in between. Therefore, they have a stake to the earnings of the company before us equity holders do as well. And they also, given the structure of this deal, they're going to be earning a 6% interest or slash dividend on their 1 billion. And eventually, this was going to cause a conversion of 10 million shares in 2028, which is around, based on the current share number, a dilution of around 15%. This is a huge factor to consider when investing in Shift4, whether or not you're going to be taking these figures for the current shares or the potential diluted figure with the 10 million included. And based on the total financing this company has done, they're going to be paying annually 251 million in interest expense from the debt they have, which is why we see a clear dip in the interest coverage ratio, and it's down at 5.37. Now, this isn't reflecting the Global Blue acquisition just yet, and I'll show you how I calculate the interest coverage ratio for this company. So taking a look at this adjusted figure, we're just going to work with the EBITDA figure that the company provides for this one, which is the 700 million plus the 200 million to get to 900 million. Now, the reason we use this as opposed to the EBIT figure is because these non-cash charges, well, they don't affect the free cash flow of the business. And as such, we can take a look at this number and say how much could they use to actually repay back the debt that they have. And we end up with a figure of roughly 3.6x, which is a fairly low figure, and I don't want to see this go any lower. I'd rather this be a lot higher, upwards of 8 if possible, because you want to make sure that there's enough coverage of the interest expense that they are paying for whatever comes their way. So as far as the corporate structure, this was a bit of a headache to try to wrap my head around it. This is how the company is, IPO'd, and they have one entity that's controlling another. So basically what's happening is you have the Shift4 Payments LLC controlled by two players. One is Rook Holdings and the other Shift4 Payments Incorporated. And Rook Holding is the shell company that Jared Isaacman founded basically to get around all the taxes that he potentially has to pay. So the way the company has been structured, you can see here, is that it's roughly, the breakdown is 75% ownership for the Shift4 Payments, and Jared Isaacman approximately owns around 25% of the LLC through Rook Holdings, which is a good sign. There is very high insider ownership, which is something we all like to see. We want to see our founders involved and have a high stake and shared incentives with us as well. But there is some shenanigans going on with the tax benefits because there is something called an Up-C capital structure. Now, an Up-C capital structure was something I haven't come across myself before, but apparently it's very common in companies like Floor & Decor, Shake Shack, and GoDaddy, whereby they've managed to find basically a loophole. Okay, so we're going to have this shell company and we're going to accrue all the tax benefits. Basically, if you are a money-losing company for a certain amount of time, you could then say to the taxman and say, okay, hey, I want to collect some of that tax benefit I'm owed, let's say from net operating losses and other things, in order to pay back myself. So it's a way of paying yourself without having to sell any of your shares, because usually these tax benefits would go to shareholders and distributed equally, but no, they have an agreement whereby 85% of any tax benefit goes to Jared Isaacman and the rest of the 15% goes to us. Yeah, it's not ideal. And you can see here the effect of the shares breakdown. Now, I've projected this into 2028 with the current structure. The actual preferred shares would convert to roughly around 10% actually, with the shares from Jared Isaacman accounting around 20%, and then the equity holders would get around 69% within the Class A common stock, and Jared Isaacman owns the Class B shares. So Class A shares are the one our equity holders are exposed to, and Class B and C shares are the ones that Jared Isaacman holds. Now, he has the right to convert these shares to Class A shares, and we wouldn't notice it within the insider activity that he's carried out a direct sale as such, but we would see potentially a conversion, but you wouldn't be able to trace it back easily. And that's one of the little quirks of this structure that he has. But the benefit of these Class B and C shares, unfortunately for us shareholders, is that they come with a 10-to-1 voting rights, meaning that on top of his 25% insider ownership, he has 75% voting rights. Now, should that be an issue for you? Well, for some investors, that's not a problem, and they've been highly rewarded. So potentially, if you've been happy to hold with Isaacman for the last 25 years, if that was a public company, then you would be happy too. Overall, we'll be able to gauge his actual incentives from the further examination of the capital structure and compensation deals within this business. Now, it's really important for us to talk about not just the Global Blue acquisition, but the recent changes that have been going on in the corporate structure of this business. Jared Isaacman, who has been running this business for 26 years, has stepped down from running the Shift4 as a CEO and shifted into the chairman role. But unfortunately, or fortunately for us, his nomination was later withdrawn by President Trump. And basically, he's resumed his role, well, let's call it resumed in a chairman-like faculty, and therefore going to be with the business and hopefully not going to have his eye off the eight ball, so to speak. Now, it's important to actually consider what would have went down had he actually transitioned to that NASA role. He actually had put some legal rules in place, or what I think was called an ethical agreement, whereby he would have actually converted all his voting rights shares to just regular Class A shares. So he would have given up his, let's say, superior voting rights and in return for just normal insider ownership as you would expect. And I thought that makes a lot of sense because you're not as invested as you were previously in the business. Maybe he would have run it just the same. You've got Elon Musk doing 6 different projects, so why not? But it's very good to know that, at least from a point of view of keeping equity holders feeling safe, or that their incentives are all aligned, that he would have done that as well. And this is just a slide on the tax receivable agreement, which we talked about at the tax benefits. It's called a TRA. And you can see here, I've highlighted it, that 85%, oh, that's too small. Let's bring it down. 85% of the tax benefits are accrued to him. And there was a recent actual tax benefit that was being collected, which amounted to around 365 million. And that's where we're going to notice a significant change in some of the earnings, and we're going to take a look at that. What we're seeing here is the tax benefit shows up as an income tax, and that's around 296. Normally that's trading around 3 million. So you can see it's a huge difference. And what that does is it boosts net income. And boosting net income means it's boosting earnings per share. And therefore, the earnings per share for this business are highly elevated compared to where they were previously. And that's why sometimes taking a look at the PE numbers are not the best, because this is a cruel method of accounting, and you have a lot of things that could influence it. And as such, going higher up might be a better method of analyzing, or getting at least a better multiple to analyze this business with. So yes, the increase in the earnings per share therefore lowered the PE value, and this company might look a lot cheaper than it might do otherwise. So, and let's just circle back to this EPS once more, because it's really annoying me that they've done this the way they have with this Up-C capital structure and the shell company that Jared Isaacman is running, because what's happening right now is that we're getting what's called a non-controlling interest net income. This net income is attributed towards Jared Isaacman's portion as the shareholder of Brook Holdings. So from the 41.1 net income that was collected, 7.1 is being routed towards Jared Isaacman. It's not actually happening in fairness, but that's what's showing up in the financial statements. And then you have the portion that's being deducted for the actual preferred stocks. Remember that 6%? So what we end up with as shareholders is 24 million. So that's a big, change from the 41 million you would have expected. Now, this is an important thing to consider. He's holding 25% of the shares. Had those shares been in the actual LLC that we are part of, as opposed to a shell company that he owns, then we wouldn't get this non-controlling interest. Non-controlling interest is usually going to be a third party, somebody who's not got their, a very high stake in the business as a founder. And as such, I think we need to ignore this and include basically the net income as part of the the non-controlling interest as part of the normal net income. And eventually we can exclude the preferred stock dividend if you really want to. But let me show you an illustration of what I mean by this. You can see here under normal circumstances, you might assume, okay, we have 41 million in net income and this portion goes to Jared, and then we end up with 34, and then the portion goes for the preferred stock dividend or slash interest, and then we end up with 24 million. But in actual fact, it's a little bit different than math. This is basically showcasing how I've managed to calculate this, and we end up eventually with something around 29 million. I think in reality, we should just include the 7.1 from Jared as into our calculation. I don't want to make this overly complicated, more than it already is, but just to say, this company is very complex with this, shell company status, as well as the net income being affected. So all in all, you might just ignore PE for this company and just look at potentially the EBIT figure instead. So the stock-based compensation for Shift4 is around 10% of net revenue, and then you get 10% for the buybacks. So you should ideally have a net zero change in shares, but what we notice is that there's a 17% share increase. So how's that been happening? Well, as I mentioned before, Jared Isaacman can convert his shares from Class B to Class A, and that's what's mainly been driving the change in dilution. Additionally, Jared Isaacman has sought to create an employee equity fund whereby he's funding around, I think it's $38 million. So a very small figure, not really a very large figure for employees that he's going to be funding out of his own shares, which is a very nice gesture. Okay, so now we've come full circle. We're going to be taking a look at the founding and culture of this business. And yeah, we've taken a look already at Jared Isaacman, but here he is at 16. And I'll leave a link to the article where I got this photo from. And yeah, he started this business with his friend on the right here, Brendan Lauber, and that's was at the time girlfriend and now his wife. And basically working at 16 and repairing computers to eventually getting hired by MSCI CEO Mario Parisi, who he eventually bought out his company and founded also the United Bank Card to help, speed up merchant solutions for payment processing and rapid growth for the next 25 years, etc. But it doesn't stop there. I mean, I'm showing you pictures of planes. Now, you might have made the connection already that this man is a very avid flyer and enjoys space. And he's actually launched another business which made him a billionaire prior to even the IPO of Shift4. In 2011, he founded Draken International. And this is one of the world's largest private fleets of fighter jets for the US military and NATO training. It's like, who does that? Runs two simultaneous businesses. I mean, you can see parallels to other entrepreneurs at the time who are just as successful. Now, he was voted, I think, also one of the 30 under 30 entrepreneurs. He came in second to Zuckerberg, I think, early on in 2005. So he has a lot of history of being at the top of his game for a very long time. And yeah, you can see some of the accolades he's collected, setting world record for flying around the world. And he's also carried out a space mission, and he funded this, actually, for this Inspiration 4. Part of the funding was to the St. Jude Children's Research Hospital, where he donated around, I think it was 200 million. What he did there was he sold some of his shares of Class B, converted them to Class A, and that showed a large sale. Now, you could say that this wasn't actually to fund his lavish lifestyle, it was more to fund things that he cared about, and I can get behind that a lot more than I can say somebody who just wants to get rid of his shares and just, splash out. And interestingly enough, in one of the interviews they had with him, they asked him, in the building of the business, what was your biggest mistake? And I'll read this out word for word because I don't want to get anything wrong or muddled up. In 2005, because we didn't want to raise debt to fund our first free credit card terminal program, we sold off a portfolio of around 15,000 merchants. We got 44 million in cash. We were debt-free. I was 22 and life was good. But in retrospect, we should never have done it. So you can see how much he values the lifetime value of customers or merchants now way more. And he's willing to leverage or get some debt instead of selling and being debt-free. Debt is a tool. If used correctly, it could actually improve your business a lot. So I think that's his own personal view on that. And another question, which I thought was interesting, was what do you see for your future? Now, this might have been around 2005, so a long time ago. Well, if I ever got out of the credit card industry, all I'll be doing is flying. But my business is my life and I love it, so I don't think I'm going to give it up anytime soon. Well, you can see that all you can be doing is flying, NASA, pretty close. So if that didn't happen, I don't think he's going anywhere. And I think Jared Isaacman is going to be integral to this business no matter what. He's a big shareholder, 25%. He is chairman, and he is the de facto CEO. He's not going anywhere. Believe me, with all that is at stake, this is his baby. He's not going to let anyone. But who's the CEO? Let's take a look. So the leadership transition happened, and the person who got nominated, well, this is Taylor Lauber. Now, you might think I've heard that name before. Well, the other Lauber you just heard of was Brendan Lauber, which is the brother of Taylor Lauber, I believe. I made that connection myself, and you can see how he's kept the ecosystem of people he hires very close, and it's a very close net, group of people that he's hired. He had his dad as chairman for the longest time until he retired, and he's taken his spot. So he's keeping it within the family. As far as management compensation goes, they use 3 metrics, and they're going to be the end-to-end payment volume, the net revenue, and the adjusted EBITDA. And the average figure of that is how they decide on how much cash bonuses they're paying out to their C-suite executives. And these are the restricted stock units that they give out. Now, unfortunately, these are not performance-based, so they're just vested over a period of 3 years, and eventually they're able to collect on these. So let's say Jared Isaacman is able to collect 12 million and 7 million for Taylor Lauber, and then you have 3 million, 3 million. Now, important to note, Jared Isaacman's RSUs are not vested. They're executed immediately. He has access to those if he wishes to. Everyone else, however, within the C-suite has to vest with it for 3 years. That's balanced out by the fact that actually Jared Isaacman does not really receive any salary. He gets $50,000 just as a token of appreciation, you can call it, and the rest of it is in RSU grants. So in reality, his salary is the RSU, you can call it, because it is invested. At least there's not some major exploitation where he gets double 9 million plus another 2 million. But 9 million is pretty rich amount, to be honest with you. And this is one of the slides I really want to share with you, because I spotted this company based on some qualitative screens that it did, plus the insider buying brought this to the forefront. Now, he had purchased 16 million shares. I think this is post the Global Blue acquisition, and that really was a big flag for me to spot the company. Now, 16 million, granted, is a small amount for a billionaire. He could splash this anytime. However, it's a very good show of strength. And in total, he's actually bought $38 million of his own company. Now, of course, he's done a much larger amount of sales, partly to fund the St. Judas charity or research center. And that was through the indirect, prepaid forward contracts. Now, what those are basically are like agreements between him and the other party to say that, can you please give me upfront $300 million in cash, and I will pay you in X amount of years that cash in shares. Either if the business has appreciated or depreciated, they can collect a larger amount or a lesser amount. Now, of course, he's banking on the fact that his business is going to perform well, and therefore he can give them much fewer shares. And as such, it's actually a lot of times what companies such as Amazon, Jeff Bezos uses in order to get cash out of the business. And thank you for sticking around so far. I really do appreciate it, and I hope that this has been useful to you. Let's go over the competitive advantages and get an understanding of where this company sits within that framework. Barriers to entry, of course, are very high because of the amount of regulations in place. It might have been the case 25 years ago that it was a lot easier to start up in this space, but the amount of licenses and regulations and cross-country, geographical rules you need to abide by, it is a headache. And also the barriers to success, given that it's a difficult space to work in, it might not be very, rewarding for people to enter the space. So I expect eventually there's going to be a lot of consolidation within the space. So let's take a look at Hamilton Helmer's framework of the 7 powers, which I think is a very, very simple way to look at it. And it's really good at breaking things down simply for a lot of people and for me. So as far as scale economies, it really had me thinking for quite some time, but eventually I settled on the fact that POS has very few scale economies associated with it, because each customer comes with their own problems. You don't have turnkey solutions you can keep rolling out, and as such you need to be ever present, customizing the solution for each customer at the venue, and then having technical support associated with that. So scale economies for that side are weak. However, once those systems are in place, the marginal cost associated with rolling out the payments is negligible, you would say. So therefore the payment side has some moderate scale economies. However, the only reason I put it as moderate as opposed to strong is because the network fees associated with that. The network fees will scale linearly no matter what payments go through the network. They don't control the entire network, and as such will always keep paying those network fees. As far as network economies, I don't think there are any network economies within this business. The addition of an extra merchant doesn't make it more valuable to the next merchant. As far as switching costs, now switching costs I believe are quite high, but it comes at a cost. To convert a customer to join Shift4, they might have multiple vendors, and these multiple vendors might be on different terms for their contract lengths, and they have termination costs. But once a customer is locked in, they're going to be locked in for a very long time, because think about it. They have a one simple solution for their entire business. Why should they give that up unless the service is subpar or very below par, that they need to migrate back to 6 or 7 different vendors that they were using before? Branding, because this is a B2B type of business, I don't think branding is as important as it would be for consumer-facing businesses. And cornered resource, not really. You could say potentially talent acquisition, through their acquisition, they get the highest talent. But again, that's just reaching. So Prosus Power is one of probably their biggest strengths. The fact that they've been able to execute this M&A strategy so well in the past, maybe it bodes well for this larger acquisition. However, only time will tell, and we'll have to keep watching the balance sheet and the ROIC over time. So what about the key company-specific risks? Well, we all know the access to the Visa and MasterCards. That is probably the same for every fintech, so I probably shouldn't include that. As far as the M&A integration risk, that's as clear as day. That is one of the biggest issues with this company that we're going to have to keep an eye on. The dilution risk, yes, that is something to keep an eye on, especially for those preferred shares. If they keep on taking more shares, or at least let's say converting those convertible notes into equity as opposed to cash, that could lead to some serious dilution. So hopefully they're going to keep to their word of saying we're going to try to pay off as much of that in cash, and maybe we're just going to pay off the interest side of things with equity. And that would limit the amount of dilution we're going to get. As far as the economic sensitivity, yes, companies in the fintech space could act as leading indicators for the economy, and as such, they are going to be tied to the overall spending of the global economy, and there's nothing they can do about this. There's very limited recurring revenue, so these contracts are not going to, as we said, subscription is only 25% of their revenue, 75% is tied to the actual spending. And there is the key man risk. Is Jared Isaacman still going to be as effective as he was as a CEO in the new chairman position? Only time will tell. Embedded finance threat, we've already discussed this, and there's a risk of disintermediation of Shift4. Let's say if Shopify or Booking Holdings says we don't need to roll out this solution. I mean, you can think of other examples of people in the actual card present space doing this. But I think that's their actual niche, card present. And I think it would be very difficult for someone to really roll this out in card present as well as they do currently. But maybe in the card not present, that's where the risk lies. Now, valuation. Now, I've been waiting to do this for some time, but today, instead of a normal DCF where we look at a bear, bull, and base case, we're going to do this with a Monte Carlo simulation. The reason I'm doing this is because of the amount of variation and potential outcomes you might get in this company. I thought I'd share this with you as a different methodology, and hopefully it will be useful to you to take a look at a different approach that you might have not seen before. But let's start off first by looking at the relative valuation for this business. Now, the current PE you'll find on one of the data aggregators is around 32 PE, and you would think that's relatively high, but then I adjusted that for the fact that Jared Isaacman's shares are being calculated slightly differently outside of the scope of the normal calculation. I assumed, let's say, all his Rook Holding shares are part of the same pool of capital or pool of shares that we have within the Class A, and that he converted every single one of them. Then we get an adjusted PE of 18 based on that. And I think it's important to do that distinction because he is not a third party. He is the founder. And as such, like you treat it just like as you would another founder, like Zuckerberg, who has all his shares in the same company. And as such, yeah, you're saying, okay, we all share in the same net income. And that's why I get a figure of 18. Now, you'd think that's the correct figure. However, I readjust that figure once more. If you recall the tax benefit, which boosted up the PE ratio, we normalize that and we end up with a PE of around 25. So I wouldn't be doing this every day, but I just thought it's a nice exercise to show the faults of the PE and what you can actually do with these numbers if you were to read the 10K. So as far as the base for my Monte Carlo simulation, I'm using Professor Aswath Damodaran's DCF template, and I've played around with it and I've adjusted things for my liking, but just want to go over some of these figures just to point them out. Now, I calculate these different things myself, which are the invested capital. It's going to be a lot different than what you find on a normal data aggregator. The revenue is the cumulative revenue of both Global Blue and the Shift4 entity. And the operating income is the figure I'm using, which is my adjusted figure, as I discussed, adding back just the intangible portion of the acquired assets. And what I end up getting, what I'm also assuming, is a revenue growth rate of around 17%. I also adjusted the share count to reflect a portion of that dilution that we're going to be getting in 3 years' time. So around 3 million of the total 10 million preferred shares. And I also assumed that the tax rate is going to be only 5% to begin with, moving upwards to 25% over the long run, given the fact that they have this untapped tax benefit yet for the foreseeable future. This figure might be a little bit too low, but as long as it's directionally correct, I am not too worried, to be honest with you, because of the numbers that we're getting here in terms of the results, and I'll show you that shortly. So I was hoping to be able to illustrate this, graphically as well as I wanted to, but unfortunately the cursor is not allowing me to show the values on the actual bar chart. What I wanted to show you guys is that the assumptions that I placed into the Monte Carlo simulation is a log normal distribution. And what that means is that there's a long tail of potential growth rates, but they mostly cluster around the 15 to 20% mark, as in the case for my assumptions for Shift4. And we're going to say that they're going to grow for the next 5 years around 15 to 20%, titrating down to roughly the risk-free rate of around 4% in the long run over the course of the next 10 years. And based on those assumptions and the other assumptions for the operating margin we said is going to be roughly around 14 to 15%. There's a minimum range of, let's say, 18% and a higher end range of around 22%. And I've used a triangular distribution for this. So you can see by the look of the distribution, that's how the data is being arranged. And based on that, the Monte Carlo simulator tool then spits out a potential rates of return that you might get from this investment. I use rate of return because I prefer to look at that number instead of a dollar value, because in that way I don't need to focus on whether or not the company is too expensive today. What I care is what it's worth in the future, personally, for me. Some people prefer to buy something for $50 today, for 50 cents on the dollar. I think that's fair, but I also prefer to look down the line 10 years and see my investment be worth a lot more. And that's where we take a look at the rate of return. Now, the rate of return here, I've actually posted the values of, so hopefully I can show you something more useful there. But you can see here that there are some values that if the rate of the growth is not high enough, or if the operating margin is too low, then we end up with too low free cash flow and a rate of return that's negative. So obviously that is factored into the Monte Carlo simulation, and as such you say that we do see here in the 1 percentile values, rate of return around -6%. Obviously not great. But what's happening around the mid portion? So you can consider the middle, the 50th percentile of a normal bell curve, if you're familiar with that, the average or base case scenario. So let's take a look at the base case scenario. So let's scroll down here and look at the 50th percentile. We're getting roughly around 13%. Now, believe me, I am being not pessimistic, of course, but 13% based on my assumptions of dilution from everything that's happening, and a operating margin that's not too high, actually. 50% is pretty good. If that's what I end up with on the low end, on the base case, then we could say, okay, 25%, 25th percentile puts us at 7%, and then things could be a lot better than that. They could be in the 75th percentile. What do we get in the 75th percentile? We get around 20%. So that's how I want you to potentially take a look at this and analyze it from a Monte Carlo perspective, because you get a lot more outcomes than you would normally, as opposed to 3 from the bear, base, and bull case. So for me, this is potentially a very, very enticing investment case, and I have to analyze it a little bit more. But we'll jump back into the summary and conclude our episode or video for today. So let's take a look at that. So what are some of the key takeaways here? I think as far as pros and cons, you can take a look at this list. For Shift4, I don't need to say that again. I think I've made my point clear. The main thing I would look at here is to make sure that you understand which multiples to look at for this business. And on top of that, make sure your eyes are on the balance sheet as well, because things can change dramatically if things take a turn for the worst. So keep an eye on those ratios we talked about. And if you were to invest in this business, I think this could be a case of potentially taking a small portion here and waiting to see how things get on in the future post acquisition, because right now they did actually culminate the deal. However, it's not shown up fully on the balance sheet, and the debt hasn't been reflected fully, and eventually we'll see how that works out. You might eventually have some impairments down the line, so there's a lot that can change over time, and I think we might be having to revisit this investment and just making sure that they are executing as they have talked about. And I'll leave you with this lovely spider chart or radar chart to highlight what I thought about the business so far in terms of the valuation, the risks involved, the management team, which I actually am quite favorable on. It's just the financials that I'm a little bit worried on mostly. Now, thank you for anyone who's persevered throughout this entire video, or thank you for at least watching a portion of this video, because I know it's not for everyone. And I hope you found it useful. I really hope that there's something to take away from this. And I'd like to share, as a token of appreciation, what I'm doing next, which is I'm going to probably be looking at a healthcare company, and I'll probably put it up for a vote because I'm not partial to either one of these. So let's see if you guys can help me decide on which company to take a look at next. And hopefully I'll see you on the next video. Take care.